Good afternoon. Used to be when I was in front of a large class, if I just stared at people who were talking. After about 15 seconds, I could quiet down a room of 200, but this is maybe a little bit more raucous audience here today. My name is Steve Fazzari. I'm Professor of Economics and Associate Director of the Wiedenbaum Center, and I'm happy to welcome you to this event as part of the Wiedenbaum Center Forum. Our title today is Monetary Policy Amid Economic Turbulence. As one of our speakers said at dinner last night, we do live indeed in interesting times. A year ago, we were facing the most severe financial crisis in 2 generations and falling into a very severe recession, which, according to some people, is over. Some others say it still continues. The actions of the Federal Reserve since late in the summer of 2007 to address these problems have been both unprecedented and also controversial. So we've assembled a distinguished panel here today to help us understand what has happened and hopefully to offer some thoughts and insights about where we go from here. Before introducing the first speaker, let me gratefully acknowledge the help of our co-sponsors for this event. My colleagues in the economics department are very helpful in putting the program together. The St. Louis chapter of the National Association of Business Economists has been provided financial support as well as publicity for the event. The Undergraduate Economics Association has been key to this event, and we're hoping to partner with the Undergraduate Economics Association for similar kinds of events going forward with the Wiedenbaum Center and the Department of Economics. Arjun and Chelsea, are you here? There they are. President and Vice President of the Undergraduate Economics Association, so students in particular, see Arjun or Chelsea if you're interested in participating. I'm pleased to introduce our first speaker today. Thomas Cooley is the Paganelli Bull Professor of Economics at New York University's Stern School of Business and holds a joint appointment as Professor of Economics at the NYU College of Arts and Sciences. Tom has just finished a successful term as Dean of the Stern School of Business, about 7.5 years, I understand. He's now enjoying a very well-deserved sabbatical, at least in California at the moment. He's published extensive research that explores macroeconomics, monetary policy, and the operation of financial markets. He is the former president of the Society for Economic Dynamics and a fellow of the prestigious Econometric Society. In response to the financial crisis in the fall of 2008, Tom organized a research and policy initiative at the Stern School that led to 18 new papers collected in a volume by 33 NYU professors, and the volume's just recently been published. It's entitled Restoring Financial Stability, How to Repair a Failed System. He also has a weekly opinion column in Forbes.com that focuses on economic issues. The title of Tom's talk today is The Challenges for Monetary Policy in the Aftermath of the Crisis. Please join me in welcoming Professor Thomas Cooley to Washington University.
All right. Thank you very much, Steve. It's a great pleasure to be here. Good afternoon to all of you. I have to say it's also a great pleasure to share this program first with a distinguished colleague of mine, Dick Silla. Dick and I share an interest in historical precedents for current events, and we both have a very strong feeling that we too often ignore them to our great peril. So I've learned a lot from Dick as a colleague over the years, and his tremendous insights have really fired my interest in understanding the roots of the financial crisis and understanding through those historical precedents what kinds of solutions have been effective in the past in dealing with financial crises. Now, my assignment this afternoon is to talk about some of the challenges to monetary policy going forward in the aftermath of the financial crisis and the great bailout. Now, it's certainly true that we've been through an extraordinary 3 years. In 2007, the credit crisis that we all, all should have anticipated, and some did, became apparent with great suddenness. The first response of monetary policy, one has to say, was best described as being in something of a state of denial about the severity of the problems. But gradually policymakers caught on and began an aggressive process of lowering interest rates and more carefully monitoring the health of the financial system. By the beginning of 2008, the federal funds rate, the target federal funds rate, had fallen by 100 basis points to 4.25. And in the course of 2008, it fell rapidly until by the end of the year, the target rate was 0 to 0.25. There was a time in late 2008 when we were literally staring into the abyss. As a friend of mine said to me at the time, we're at a point where it's not clear if you put your card into the ATM machine tomorrow that you'll be able to get anything out. We had exhausted the usual tools of monetary policy, and we were embarked on a series of operations that are now referred to collectively as unconventional monetary policy, by economists, I should say. So the year 2008 was marked by a remarkable series of dramatic and calamitous events. Perhaps the first was the failure of Bear Stearns and the forced marriage to J.P. Morgan Chase. That was followed by the receivership of Fannie Mae and Freddie Mac, the bankruptcy of Lehman Brothers, the merger between Merrill Lynch and Bank of America, the very expensive rescue of AIG, all events which are still in the news today, and the conversion of the remaining big investment banks into bank holding companies, the creation of the Troubled Asset Relief Program called TARP, emergency loans to General Motors and Chrysler. For all of us, but I would say especially for economists and people involved in financial markets, it was simply breathtaking. Now, by comparison, the year 2009 has seemed relatively calm. Of course, that's not really true, since it began with the inauguration of a new president, a big debate about stimulus and the effectiveness of stimulus, the bankruptcy of General Motors and Chrysler, the rolling out of plans for reforming the financial regulatory system, the new administration's proposals for helping the housing sector and removing troubled assets from the balance sheets of banks, both programs which have been largely ineffective. On top of this, we've been experiencing the worst recession in the post-war era. So it hasn't exactly been a picnic in 2009. What I think is true, however, that as a country, we have been breathing a sigh of relief precisely because what happened in the last 2 years did not turn into a repeat of the Great Depression. And when we ask why it didn't turn into a repeat, I think a lot of people come to the conclusion that it was because of Federal Reserve policies and the actions they took to provide liquidity to markets that were essentially frozen. What we've seen represent true innovations in monetary policy, and they represent monetary interventions of the sort that were designed to keep markets functioning in a desperate circumstance. Once the Federal Reserve had cut interest rates as far as they could be cut, they needed more tools. So as a consequence of this, in the process of salvaging some very sick financial institutions, the Federal Reserve took onto its balance sheet some very non-standard assets. This process has been described as quantitative easing or credit easing, and all of a sudden, its balance sheet began to include a huge variety of different assets. In a relatively short time frame, the Fed increased the size of its balance sheet from something like $900 billion to over $2 trillion. In the process, the Federal Reserve became the largest buyer of mortgages in the United States. It purchased a major percentage of new treasuries issued and sold over the past year. And one implication of this is that the Federal Reserve was not only conducting monetary policy, but they were allocating capital to certain sectors, in particular to the housing sector. Now, an important lesson to take away from all of this is that the Federal Reserve over the past 2 years has been engaged not just in monetary policy, but in fiscal policy. And its other focus has extended far beyond regulation to making decisions about which institutions should be saved and not saved, deciding how contracts should be resolved or honored or not honored, and allocating capital in the economy. They've actually strayed quite far from their primary function of designing and implementing monetary policy and providing lender of last resort facilities. As a consequence, they subjected themselves to a great deal of scrutiny on the part of Congress, a lot of populist anger in the U.S. that is bubbling constantly, currently, is directed at the Fed, which is viewed as, and in my view, in my opinion, it's a view that is quite justified, as having played a huge and secretive role in bailing out the financial system. So when we discuss the challenges for the Federal Reserve going forward, it seems to me that we really need to separate the discussion into two pieces. First, there are the challenges to monetary policy. And those are complicated and interesting, and they're going to be trying. But secondly, there are the broader challenges that the Fed is likely to face, and indeed is already facing, as a consequence of the actions that they took in response to the crisis. So I want to separate my discussion into talking about first the challenges for monetary policy, and then the more broad challenges for the Federal Reserve as an institution. So let me begin by, by the way, I'm not going to give you a great slideshow here. I only have 3 slides, so. But let's begin by looking at the Fed's balance sheet and how it's changed over time. So the first figure I have for you shows the Fed's balance sheet in all of its gory detail. And you can see from this what the Fed has been doing. Now, traditionally, the Fed creates money by buying Treasury securities from private holders and crediting their accounts with deposit at the Fed. These credits are money that replaces the Treasury securities now owned by the Fed. In short, the Fed acquires an asset and creates a liability, the money or deposits of reserves. As the year 2008 and the financial crisis unfolded, the Fed began to use its balance sheet in very different ways. It began to change the composition of its assets. So this happened through the many new facilities that it created to hold non-treasury assets, making more liquidity available to the financial system to keep the system functioning. And if the Fed had simply bought more assets of different types, it would have been creating more money at the same time, creating the potential for inflation. Instead, what it did was to change the composition of assets, and that's this period here, by selling some of the Treasury bills and notes in its portfolio and replacing them with other assets. So this was a major departure from the prior policies of the Fed, but one that was predicated on the hope that the assets it was taking on would be money good over the long haul, and that the fact that it was taking them on would help to stabilize the financial system. Now, all of this changed when credit markets seized up in September. Because virtually all markets were frozen, the Fed was forced to become the lender of first resort, and this began the dramatic expansion of the Fed's balance sheet, which you see here. I realize that you probably can't discern the colors that in much detail, but included in this are a tremendous variety of different assets. The assets included credit from term auction facilities, commercial paper that was taken on to keep the commercial paper market functioning, credits extended to AIG, the portfolio holdings of various what they call maiden lane structures, which were created to hold the assets of Bear Stearns and AIG, and so on. And this meant that as it purchased these assets, the Fed was also creating more liabilities as well. And at first, the expansion on the asset side was matched by increased non-bank liabilities, mostly in the form of higher balances that were deposited by the Treasury into its regular and supplementary financing accounts at the central bank, money the Treasury borrowed on the open market. So this meant that the increases in assets for a while were sterilized. They didn't represent an increase in the money supply. But eventually the increase in assets stopped being sterilized or matched by non-bank liabilities, and the reserves in the system increased dramatically. So this is a summary view of how of what the Fed did. So this part here represents the traditional security holdings of the Fed. This little bit here is their holdings of long-term Treasury bills, which is something program that began this past year. Lending to financial institutions, and you see that and liquidity to key credit markets. So you see that these two parts of the balance sheet have in some sense been self-liquidating. Once the markets got going again, there was no need for the Fed to be propping up the commercial credit market and so on. And then the other big part is federal agency debt, mortgage-backed security purchases. So that's the overall shape of the Fed's balance sheet. Now, having created all these reserves in the banking system, the problem for the Fed going forward, and it's a problem that's much discussed in the media, is how do you have this balance sheet and not create massive inflation? How does the Fed prevent all the reserves that it's created in the banking system from causing inflation? And the big question that a lot of people have in mind is, will it have the political courage to raise interest rates and to address and to restructure its balance sheet if and when inflationary pressures begin to mount and the economy is in a still fragile recovery state, which it is right now? So I just want to show you one or two more pictures, which I think emphasize how fragile the state of the economy is. So this is a plot of, this is the path of private employment over this business cycle from the beginning of the downturn. And this shows you the typical path of private employment over 3 previous cycles from the beginning of the downturn. So you can compare the severity of this cycle with the severity of prior business cycles, and you can see where we are with respect to this recovery. And it's no secret, it's been item number 1 in the news for the past couple of weeks that the labor market in this country is still in very, very bad shape. So 81 and 73 were severe business cycles, but nothing like this one. 1990 and the 2001 business cycle were relatively mild business cycles. There are a number of other charts for other variables like this in my most recent Forbes column that give you pictures of consumption and investment and everything. I'll show you one more picture, which is the thing that I like to look at, which is the employment to population ratio. This is the fraction of the population 16 years and over who are employed. And you see this shows an even more dramatic downturn that's still increasing. So this picks up all the effects of discouraged workers, underemployment, and so on. So this gives you a pretty dire picture of where we are. So if anybody doubts that the recession, that the recovery may be a ways off, I think this picture should hopefully at least moderate your view. So eventually the Fed is going to have to drain reserves from the system, and that's what's going to have repercussions elsewhere in the economy. Now, I actually, for one, think that these problems are quite manageable. So I think that the problems of monetary policy per se are manageable for the Fed. It's well known that the Fed has been developing new tools to deal with these problems, to figure out how to deal with this huge balance sheet. First, they now pay interest on reserves, which is something that economists have advocated for many decades, for a very long time. And this gives them another tool to manage their balance sheet. So the idea is that by paying interest on reserves, if the interest rate is high enough, that banks will be encouraged to, those who have reserves in the system will be encouraged to leave them in the system, keep their reserves on the balance sheet. Now, there are two problems with this. One is it's not without peril, because in a very strong economy with lots of investment opportunities, it would not be unheard of for banks to demand significant rewards to keep their reserves there. And of course, it's only a short-term solution. Eventually, the Fed is probably going to want to shrink the size of its balance sheet. The Fed has also been experimenting with a reverse repo facility which would let them lend the assets on their balance sheet out in return for short-term borrowing that would essentially neutralize the monetary implications of a lot of these things. But what to do about the size of the Fed's balance sheet is a little more problematic. Now, a lot of people have suggested they could just leave it at this size and try to neutralize the monetary implications of it through these other mechanisms. But some of the programs that are put in place, like credit facilities for various markets, as you've seen, are self-liquidating, but the more troublesome ones are not. In the long term, the Fed's participation in the mortgage market, it has become the largest purchaser of mortgage-backed securities in the U.S. And the participation in the market for long-term Treasury securities is also worth thinking about. Once the Fed stops buying this stuff, it's going to put pressure on housing markets. In the U.S., it's going to put pressure on mortgage interest rates. Now, they could sell them, but if they were easy to sell, the Fed wouldn't have had to step in and buy them. It also, if it starts trying to liquidate its position, it's going to cause further deterioration in those markets. So what the Fed has been doing by buying these mortgage-backed securities and so on is really executing fiscal policy without congressional authority. It's really the case that the Federal Reserve should not be in the business of propping up particular sectors of the economy, the housing market, and allocating capital to that particular sector. That's really the role of the Treasury. And going forward, the Fed is going to have to find a way to shift their role to the Treasury where it belongs. Now, the reason why they haven't done so is obvious, because for the Treasury to do it, the Treasury would have to seek congressional approval to do these things. And no one in Washington has been willing to confront the problems that the housing market and Fannie and Freddie represent for the economy. Nobody wants that on the government's books because the fiscal condition of the economy will look worse if that stuff is on the books. All that said, I don't doubt the Fed's willingness to do everything in its power to ensure an orderly evolution of its balance sheet without triggering inflation. That part of monetary policy is difficult and it's going to be challenging, but it seems to me it's pretty well in place. They've been preparing for this, and they're going to, I think, be able to I think they're going to have time to execute it, and I think they're going to be able to execute it successfully. So let me talk about what I think are the larger issues in the few minutes that I have left. These are the challenges for the Federal Reserve more broadly. Now, in the process of responding to the dangers posed by the financial crisis, the Federal Reserve undertook a number of actions which I think create far greater problems for them in the future than the simple problems of monetary policy. Now, I'm not somebody who likes to point the finger of blame at anyone. The blame game has no winners. And I'm not sympathetic to people who want to blame the financial crisis on Alan Greenspan or Ben Bernanke or the Chinese or anybody. But it is clear that the Fed dropped the ball on regulation, it dropped the ball on consumer protection, and so on. But it's also important to acknowledge the decisions that were made in the heat of a crisis that was unprecedented. And the decisions that they made at the time may have important consequences for our long-term financial stability. So let me just give you a list of my concerns. First, the Federal Reserve got involved in making decisions about which financial institutions should be rescued and which should be allowed to fail. Lehman and WashU were allowed to fail, others were rescued. They gave bank holding company status to a number of firms and gave them access to the Fed's discount window. They made bold decisions to prop up certain markets, housing market in particular. They engineered the mergers of shaky financial institutions, creating banks and large complex financial institutions that were even larger and arguably riskier than had existed before. And in the process, they created massive amounts of moral hazard by articulating the policy that many institutions were too big to fail. Because of all these things that have attracted the great ire of populists and the greatest threat to the independence of the Federal Reserve since the 1950s. So the biggest challenge for the Federal Reserve going forward is going to be to address these issues. First and foremost, if the Fed loses its independence because of this populist insurgency, that's going to pose a greater threat to inflation in the long run than are represented simply by its balance sheet. First and foremost, among the problems that have to be addressed are the problems of financial institutions that are too big to fail and the moral hazard that represents. What it means is that these institutions have insurance that's provided by you and I, by the taxpayer, that encourages them to be riskier, that gives them lower costs of capital and encourages them to allocate capital in ways that may not be in the best interests of everyone. To address that, we have to figure out mechanisms that allow for the orderly failure resolution of firms like this. And then secondly, we have to figure out how to price and measure the systemic risk that these firms create and make them pay for creating it. And as I said, it's also critically important that we preserve the independence of the Fed in formulating monetary policy. It may well mean, and in my view it does mean, that expanding the role of the Fed to give it responsibility over the regulation of systemic firms, as many people have discussed in the past year, is not something we ought to do. That in fact, we ought to narrow their role and their focus should be directed to the formulation of monetary policy and the execution of their lender of last resort role, and that they should play sort of an ordinary role in the regulation of member institutions. I've written a lot about these topics, and I have a lot more to say about it, but I think I'm right on time, and so maybe this will be a good place to wrap up and leave other discussions about this for the question and answer session. But I do want to refer you to, Steve very kindly mentioned the book that my colleagues and I produced last March on regulating financial institutions, and we have a new book that addresses specifically the issues of regulating systemic risk and how to restructure financial regulation, and in particular offers up-to-date commentary on the proposals that are being debated in Congress. And you can read these writings all online at the Stern School of Business website. So I invite you, if you want to see a little more detailed discussion of our views on things like everything from regulating CEO pay to derivatives markets to designing financial architecture, I refer you to that site. So thank you very much, and thank you for your attention.
Thank you, Tom. That was great. Very interesting. Obviously very topical. We're continuing now with our connection to distinguished faculty from New York University. It was actually a bit of a coincidence that the two keynote speakers for the conference turned out to be colleagues and, as I understand, golfing buddies too, so that's a good thing. I am pleased to introduce Richard Sylla, the Henry Kaufman Professor of History of Financial Institutions and Markets, and a Professor of Economics, Entrepreneurship, and Innovation, all at the New York University Stern School of Business. Dick is an expert on money, banking, and finance with a particular emphasis on financial history. He's published extensively, and he served as president of the Economic History Association and president of the Business History Conference. He is currently a trustee of the Museum of American Finance. He received the Citibank Award for Excellence in Teaching at the Stern School of Business. Dick's talk today will clearly exploit his deep historical perspective, as indicated by his title, Our Great Recession in the Mirror of the Great Depression. Please welcome Professor Richard Sylla.
Thanks a lot, Steve, and thanks to the Wiedenbaum Center for inviting me here. It's a great pleasure to be here with you. Tom mentioned that study the Stern School turned out. It was a rather amazing thing. About a year ago, November 1st, somebody had the idea that there was enough expertise in the Stern School to actually give some advice to the world on the financial crisis and how to restore financial stability. Tom was pushing that as hard as anyone. And I remember one dean. I'm so old that I've had a lot of deans. But I remember one dean at NYU. I'm sure people at Washington University have heard this too, that being a dean is like herding cats. It's not easy to herd cats. Well, you know, that dean said he wasn't able to do it. But I think when Tom got this project going, you know, he was such a good dean that he had actually mastered how to herd cats. He did it, and now he's doing it one more time. I was struck. We did not cooperate at all on this. You probably won't believe that, but Tom's been in California for the last 2 months, and I've been in New York, and we didn't cooperate at all. But as I was listening to him, I said, geez, we're concerned about more or less exactly the same things. So what I wanted to talk about today, with a little more historical background, is you know, how the Fed behaved in the Depression era. I want to look at the Fed 70, 80 years ago and compare it with what went on now and bring up some differences between then and now. But one of the differences is not going to be that it's a brand new thing when the Fed balance sheet doubles over time. That happened in the 1930s. It happened in the 1940s. Unfortunately, it didn't happen from 1929 to 1933, which is why the Great Depression was as bad as it was. But you will see in my talk, I have balance sheets there, that the Fed balance sheet doubled from 1933 to 37, and the Fed balance sheet then doubled again, I think, to 1941, and then it doubled again in World War II. But that was a kind of a different situation, and the Fed balance sheet didn't double so much because of policy. So there is a difference. You know, the Fed balance sheet then took 3 or 4 years to double. Now, I think we saw it doubled in a couple of months back in 2008. All right, well, this will be a little bit of a course in economic history, crash course here. let's see, I have to go that way. Financial crises are not new. I teach a course on the development of financial systems and financial crises, focuses a lot on the U.S., but you can go back in U.S. history and find all sorts of financial crises. They're part of the capitalist system, it seems. And people write papers on each one of these crises. There's a number of ones. It seems like the chart makes it look like we've had more financial crises in the last 3 decades or 4 decades, which maybe some of us just remember them better. But so there was in the 19th century there were some real doozies there too. So it's nothing new. I'm sure people in the room will remember some of the ones in the right column, and financial historians spend a lot of time talking about the ones in the left column. One thing that I've noticed is that a lot of financial crises just have 1 year attached to them. And some of those are not so bad, but whenever a financial crisis seems to have more than 1 year attached to it, it's probably quite a bit worse. And the one we're in now seems to have at least 3 years attached to it, maybe more. Nonetheless, despite all these crises, the story of U.S. economic growth over 2+ centuries is a good story. This is our best guess as to how the real GDP per capita in the United States evolved from 1790. It goes up through 2006. I think the interesting thing that you see there is the 1930s. The biggest decline in U.S. history happens in the early 1930s. Then there's a pretty good, V-shaped recovery there. You go down pretty fast, then you come up pretty fast from 1933 to 1936. There is the recession of 1937-38, which just looks like a slight downturn there. A lot of those financial crises, by the way, just look like a flattening out of the curve in previous history. And then there's the great boom of World War II, and then the economy gets back to evolving at its long-run rate of growth. You could probably pass a straight line through that pretty well, but if you stare at it a little more, you begin to think it shows what economic historians call a gradual acceleration. Like growth might have been, let's say, 1 to 1.3% a year in per capita real growth in the early 19th century, maybe more like 1.5 to 2% a year in the late 19th, early 20th century, and then maybe more like 2% a year for a lot of the 20th century. So there probably should be a gradual acceleration, which is what you might expect if a modern economic growth is about a sort of modern sector, industry, services, and an old-fashioned agricultural sector. We're seeing it in China now. As people leave the agricultural sector and move into the modern sectors, the rate of growth goes up a lot. So that's what despite the financial crises, there's a pretty good long history of steady economic growth. The patterns of financial crises, you can find this in Charlie Kindleberger's book. Since I'm at Washington University, people in the room probably know that Charlie Kindleberger got a lot of his ideas from Hyman Minsky, who was a professor here for many years. It's almost, the descriptive terms on the left, I think, are almost due to Hyminsky. And in the upstage, there's a displacement. Something changes people's attitudes. It might be the end of the war. It might be the introduction of a new technology, leads to sort of optimism. You get boom, speculation, mania. The pattern is then during the upswing, everybody wants to get out of stodgy old cash and into those assets, houses, stocks, bonds, land that are going to rise rapidly in value. So that's the upside, build up to a financial crisis. Then something happens. Distress happens. The distress in the recent crisis was that the price of houses didn't keep rising. It leveled out and started to come down. And then everybody heads for the exits, and you get just the opposite behavior. Everybody wants to sell these assets that have suddenly become hot potatoes and get back into stodgy old cash because it's safe. And this is called deleveraging or liquidation, and often involves panics and crashes, deleveraging. And then the questions are, is this going to have a really bad economic fallout, or are we going to have somebody step in, which Tom was talking about what the Fed did. The Fed stepped in a major way in this crisis. That's the pattern. What is a central bank supposed to do in a crisis? This is worth thinking about. This is the actual quotes from Walter Bagehot on Lombard Street. And I published a paper last year where I found a letter in 1792 when Wall Street was having its first crash. This is a letter from the Secretary of the Treasury, Alexander Hamilton. In the middle of the crisis of 1792, the letter had not been in the public domain until 2005, but the letter showed clearly that Alexander Hamilton anticipated Walter Bagehot by basically Hamilton said, lend freely but at a high rate of interest so people know you're getting a favor. 7 or 8 decades later, Walter Bagehot said the same thing. And there are 2 rules, he said. The loans the lender of last resort or central bank makes should be made at a very high rate of interest. I think Tom said, and many people in the room know, that the Federal Reserve didn't exactly do that. It made a lot of loans at a very low rate of interest in this crisis. So that's one difference between the current crisis and the classical rules of central banking. And then the second set of rules is that, at this penalty rate, Bagehot didn't use the term penalty, just a high rate of interest, the advances should be made on all good banking securities. And then later on he says what he means is on what in ordinary times is reckoned as a good security. Things like government bonds. I mean, government bonds may tumble in a financial crisis, but in ordinary times they're considered a good security. And the loans should be made, let's see, the alarm of the solvent merchants and bankers. So these are supposed to be loans made on good what in ordinary times is good collateral to firms that are solvent. Well, the Fed in this crisis lent at low rates of interest, probably to some firms that were insolvent. So, we're in a new world now of central banking because Bagehot's rules were not exactly followed in this crisis, and I think that's what Tom referred to some misgivings he had about what the Fed did or some worries he had. I have exactly the same misgivings. The Fed changed the rules of central banking. It's like a whole new chapter of central banking. I think later on say that in the slides. But it's quite interesting to think about what the differences are. 1929-33, I said I would talk about this crisis in the mirror of 1929-33. And here's a kind of description. The stock market crash, in my view, is overrated as a contributor to the great downturn of 1930-33 because you never heard this because most schools say, well, the stock market crashed in 1929 and then the Great Depression followed in the 1930s. But in fact, most of the down movement of the stock market crash proper, that is the big decline in stock prices from October 24th, 1929 to November 10th or 12th, 1929, that was the stock market crash proper, and almost all the price decline then was recovered by April 1930. That's what the books never tell you. I read the New York Times, and historians like myself, when we checking up what really happened, it's so easy to do now with all the modern technologies of online papers and indexing by words. I read the New York Times in the middle of April 1930. They were not talking about the great crash of 1929. They talked about the break in the market last fall, which was, something. There was a break in the market last fall. That was the New York Times in April 1930. What really happened is that banks later in 1930 began to fail right and left and did so in waves of bank failures. And the Fed and the Treasury, unlike now, did very little to prevent those bank failures. So the stock market ended up losing 90% of its value. The money stock collapsed. Prices deflated. Real GDP fell by a third. That's that down movement in the 1930s V that you saw on that previous slide. And then Roosevelt came in. Unemployment rose to somewhere between 20 and 25% of the labor force. We hit 10% now. I think I saw a news flash this morning that the rate is down to 9.7, just announced today, which is encouraging if it's real. So then Roosevelt came in, and we got New Deal financial reforms. We're almost in that stage now of, the worst things have happened, and we're figuring out how to prevent it in the future. We're having financial reform legislation moving through Congress. There are some slides here which I'll just go over quickly. And by the way, I'm willing to, I see a gentleman in the front row taking pictures of my slides. If he would just give me his email, I'll send them to him, or Steve Fazzari has it, and he can send it. This is available to anyone who wants it. You just get in touch with me or somebody else, because there's a lot of information here. And here's a chart of the GDP from 1919 to 1939, and does this have one of these pointers on it? The top button. Yes, there. Well, here's 29 there, and what you see that consumption expenditures were $79 billion in 1929 dollars and 29, and they're down to $64 billion. So a collapse of consumption, even more dramatic in investment. $16 billion of investment spending in 1929, hardly anything in 1933. Construction, we won't bother with that. But the GDP, $104 billion in 1929, and it's $76 billion. So it's something like a drop of 25% in GDP from 1929 to 1933. How did that happen? Well, deflation was a major problem then. A lot of what the Fed did was based on the fact that Ben Bernanke knew that, he picked it up from Irving Fisher, that deflation is bad, and it sort of makes the downward spiral continue because good loans turn into bad ones when the price level falls. And the price level, this is wholesale prices, 62, let's say, in 29, 42 in 1933. That's a big drop in wholesale prices. Consumer prices, 73 down to 55. Big drops. The implicit GDP deflator from 100 to 75, 25% drop in prices in 4 years' time. That turned a lot of good loans into bad ones. Banks and businesses failed. Workers were unemployed. The money stock, the main Milton Friedman argument here, this is probably from there. It's from Temin's book, but I think it's the Friedman-Schwartz data. M1 from 26 billion to 19. This is, the money stock hardly ever goes down in U.S. history because we're a growing economy, as my slide showed. But this was a case where the money stock went from 26 to M1 to 19, M2 from 46 to 30, and these are the determinants of the money supply. Basically, the public lost confidence in the banks, so they pulled their money out of banks. That led to a contraction. And then the banks, then as now, got very scared about lending, and so they reduced the amount of lending they did, which meant that the number of deposits they created per dollar of reserves took a big tumble. And so the public pulling money out of banks and the bankers become very conservative in their lending cooperated in this major drop in the money supply. And here's from Friedman and Schwartz. What I was just talking about is the bank's deposit reserve ratio. You see the banks in 1929 created $13 of money for every dollar of reserves they had, and by 1933 it's down to $8 of bank money created per dollar of reserves. And that happened as these crises took place. Here's the public losing all confidence, the deposit currency ratio. Most of us have the deposit in a bank, most of us have currency in our pocket. In 1929, Americans had $11 in the bank for every dollar they had in their pocket. Then they didn't trust the banks, so they ran on them, and by 1933, they have less than $5 in the banks for every dollar in their pockets. They just gave up on banks, with reason. The banks were shutting their doors. Unemployment, this is sinking. This is an upside-down chart. It goes, the low numbers are there and the high numbers are here. In 1929, about 1 million people were unemployed. 1932, 33, 12 million people are unemployed. So that was the effect of that particular collapse. It's not been a picnic this time, but it's not nearly as bad as that. The policy responses. Well, fiscal policy, Keynes hadn't written his general theory. It wasn't published till 1936. And if you read the history of that era, even Herbert Hoover talked about launching some forms of infrastructure spending, but he also talked about balancing the budget. They just didn't have much of a modern idea of what to do, and whatever they did, it was very limited because it wasn't tried. I mean, there were some increases in federal spending, but they were matched by reductions in state and local spending, and so if you look at the overall numbers, there's not much stimulus at all. The monetary policy, Fed didn't do very much. I'll show you that with balance sheets. Then, in 1933, Roosevelt actually changed the policy. He took our gold away from us, and then we devalued the dollar, and that seemed to have a really good effect of drawing gold to the United States and help the money grow. Then in the middle of the 30s, it's relevant to now, I think, because we have a lot of cross currents talking about what we should do now. Paul Krugman says we should double the stimulus. A lot of people in Washington say these deficits are out of control. We have to cut back on spending. Even President Obama, who's spending a lot, says we have to cut back on spending. So it's a bit like this period in the mid-30s when they decided maybe they should cut back on spending and maybe they should worry about the bank's excess reserves and get rid of them. That's what produced the recession in 1937-38. Stimulus spending. Here's what I say. Government spending plus exports minus imports. By the way, exports went about to zero, so this is mostly government spending. In 1929-32, it's kind of fairly steady in a range of 9.2 to 10.4 billion. 33-37, hardly much change. 10.3 to 11.9, despite all that New Deal spending. Well, the problem was state and local governments are cutting back. We can't just look at the federal government. 1938-39, Roosevelt finally, maybe Lord Keynes got his ear by that time. Roosevelt did start spending a little more, and the war situation was heating up in Europe. So by the end of the 30s, there was actually a little more government spending. Here's what the Fed balance sheet looked like in 1929. It's $5.4 billion. And gold, the Fed is basically an institution here that has some reserves of gold or gold certificates, and it's issuing a lot of Federal Reserve notes on the basis of that. Here's the notes and the deposits, which are bank reserves. Note, see, that's 4.1, and behind the 4.1 of Fed liabilities is 3.1 billion of gold. Not so much in the way of government securities. So those two things are it held gold and created banknotes. That's what the Bank of England did for much of its history. So that's 29. 5.4 is the total. Come to 1932, and these are end-of-year data, that 5.4 has only gone up to 6.1. The amount of gold is about the same as it was in 1929, and what do we say before 4.1? Now we've got 5.3. There's a little bit of an increase, but not very much. And the total size of the Federal Reserve balance sheet, 1929 to 1932, moved from 5.4 to 6.1 billion dollars. And so that's not a really big increase. Now let's see what happens. This is, by the way, this is President Roosevelt's executive order of April 1933, here in the land of the free and the home of the brave, where under executive order, all persons are required to deliver on or before May 1st, 1933, all gold coin, gold bullion, gold certificates now owned by them, and so on. And somewhere it says, well, at the bottom, criminal penalties for violation of this order, $10,000 fine or 10 years in jail. That's happened in the first month or so of the New Deal. They took it. And then Roosevelt got all the gold for the government, and then a few months later he said, it's worth a lot more, $35 an ounce instead of $20 an ounce, roughly speaking. Well, that turns out, that sounded like I sounded like a right winger there saying Roosevelt's taking away our freedoms, but this turns out to have been a useful thing for him to do. I mean, devaluing the gold. Because when he did that, there was an inflow of gold from Europe, and so the Fed balance sheet is going to double from 1932 to 36, unlike 29 to 32. And then after the recession of 36, 37, it's going to double again, and we can take a look at that. Now you see, remember we had $3 billion in gold in 32 and not much different in 1929, but now we've got 1936, $9 billion of gold. So the gold is coming in from overseas, and the Fed is expanding its issue of notes and bank reserves. Now we've got that up to, was about 4 or 5 before, so those things are going to double in those years. And the balance sheet doubles from $6 to $12 billion in 32 to 36. There was a strong recovery. This is, so there was a doubling of the Fed's balance sheet in the 1930s, and it was associated with a strong recovery. But it wasn't so much that the Fed did it consciously. It was Roosevelt helped them by drawing gold to the country when he changed the value, when he devalued the dollar. This is what happened in that era. You see the money stock growing. The shaded part, this again from Friedman and Schwartz, the shaded part shows the recession of 37, 38. Now you see the public's confidence in banks is coming back. That was another amazing thing that Roosevelt did. You saw that this was something that was headed down right to that point. And now when Roosevelt comes in and talks about deposit insurance and fireside chats, any bank that we reopen, you may safely put your money back in it. And so that, and the public believed them. The bankers, on the other hand, still are shell-shocked. They kept reducing their deposit reserve ratio through the 1930s. And I think it's just like today. They love to hold those excess reserves. They didn't really have the problem that Tom was worried about. They have all these excess reserves now. Can the Fed mop them up before we have a lot of inflation? That did not seem to be a problem. For the whole decade of the 1930s, the bankers were shell-shocked and reluctant to increase lending. Now the Fed, Tom did not mention this, but I think we might think about it. If you have to get rid of reserves, the Fed got in the Banking Act of 1935 the ability to raise reserve requirements. And they did. It's like a kid gets a new toy and starts using it and maybe even abusing it. And so the Fed got this new toy in 35, and then it looked at like we're doing now, we're looking at the balance sheets of the banks and finding out they have all those excess reserves. So the Fed was worried about inflation in 1936, and so it raised, the reserve requirements were 14%, 13%. The Fed in 3 up moves raised reserve requirements from, almost doubled them, I guess, almost doubled them. It looks like they're 12, 13, up to 25 or so. And of course, that changed a lot of excess reserves into required reserves. We should remember that that's something that's available to do now. I'm surprised people don't talk about it more. One reason they might not talk about it more is it had a bad effect at this time. The banks, we know now, really wanted to hold those excess reserves. The bankers slept better at night knowing they had a lot of excess reserves, and when the Fed took their excess reserves away from them, as we saw in the previous slide, the banks cut back further on their lending, and we had a bad recession in 1937-38. All right. Could the Fed have done more? Well, I think people believed in the gold standard then. I used to agree with Milton Friedman, who said they could have done more. They had the power to do it. Some of the more modern interpretations say, it's easy for Milton Friedman to say that in the 1960s or later, but if you put yourself back in the 1930s, the Fed believed in the gold standard. The public believed in the gold standard. So the Fed acted to protect its gold stock, and if it didn't do that, the public might have panicked even more. So, we can look back in history and say, well, our ancestors should have done something in a better way, but if you actually look at their mindsets, they might not have been able to do it that well. Now, the Fed balance sheet, 32, nearly doubles in World War, from like in 32, 36, and 37, 41, mostly due to gold inflows. It doubles during World War II, and the economy more than fully recovers, as we saw in my GDP chart. But then, now this was a conscious policy decision, but it wasn't a decision of the Federal Reserve. The Federal Reserve was just sort of enlisted in the war effort and was under the thumb of the Treasury, and the Treasury told the Fed to double its balance sheet, mainly by buying Treasury bills that the rest of the public didn't want to buy. Almost, in World War II, almost all the Treasury bills the Treasury issued had such a low interest rate, 0.3%, that nobody outside wanted to buy them, so the Federal Reserve bought almost all of them. And so that was the Fed being commissioned in the Army. The Treasury was the general, and the Fed's balance sheet doubles. Then after the war, they kept inflation down during the war with wage and price controls, and then they took them off after the war, and the price level basically doubled. So here's the Fed balance sheet. Remember, it was $12 billion, I think, in 1939, and here now it's this is 41. I think 37 it was 12 billion, and here this is 41. Now it's up to 20 billion. More gold has come into the country. More gold has come in. There's a big expansion of Federal. So this is actually the doubling of the Fed balance sheet from 1937 to 41. It went from 12 to 24 billion. And again, the main factor was the inflow of gold. Now, this is 1946, the end of 1945. The Fed balance sheet has doubled again, or almost, not quite. It went from 24 to 45. Gold actually went down. What went up a lot was the Fed's holding of government securities. As I mentioned, the Fed bought almost all the Treasury bills in World War II. The balance sheet doubles. There's a lot of notes. There's a lot of reserves available. So these are examples of the balance sheet of the Fed doubling previous times in history in relatively short periods of years, not periods of months. Our crisis. What can we say about fiscal policy? Well, despite rising federal deficits, there's some parallels with the 1930s. Some of what the federal government is spending is being offset by state and local governments that are in trouble not spending so much. Monetary policy, the Fed balance sheet more than doubles. That's Tom and I are talking about the same things now, the innovations of Bernanke. This is a whole new chapter in the history of central banking. Previous doublings of the Fed balance sheet took years, not months. It's also, and Tom mentioned this, there's a backlash. There's a backlash because of what happened. That's not unusual in American history either. Here's my chart, which is just cribbed from the Wall Street. Tom's were much more colorful, if no more decipherable than this one, which I just talked, but anyway, you get the idea that the Fed balance sheet expanded very, very rapidly in late 2008, and it's up and down a little bit, but it's just expanding again now. Here's the Fed balance sheet in 2007. Tom mentioned that. It had about 900. Then the Fed had basically a bunch of government securities on this side, and it had a bunch, gold's no longer here. It had a bunch of government securities on this side and a bunch of Federal Reserve notes on that side. Deposit reserves are very low now, so and we have some capital there. But it's a $900 billion of Fed balance sheet. Here's what it is in 2010, just like a week or two ago. Now it's, I get 2.25, it made somewhere 2.25 to 2.3 trillion dollars. And the government securities are actually less than they were in 2007. Federal Reserve notes are up about 100 billion, I think. But here's the things Tom talked about. Agency debt, mortgage-backed securities, term auction credit and loans, portfolio holdings. The Fed is like an investor now, has a portfolio of investments. That's Maiden Lane 1, 2, and 3 LLCs. These are companies that the Federal Reserve formed to hold Bear Stearns assets, and I think they're being managed by BlackRock. And there's the TALF LLC. And then you've got some preferred interest. The Fed seems to be an investor in something called AIA Aurora LLC and Alico LLC, which is, I think, related to AIG. And so this is a very different balance sheet, and it has, private stuff, private assets on it. And that raises the questions that Tom was mentioning and worrying about a little, and I feel the same way. That's something that, this is what's really new, and it raises a lot of questions. Tom mentioned the Fed is sort of getting into fiscal policy, and it's getting into determining the allocation of capital. It's not only violating Bagehot's rules, but it's making all these other things that Bagehot never imagined a central bank could do. So we have this backlash. Well, this is nothing new in American history. For 2 centuries, Americans seem to have had a phobia about concentrated financial power. We had a very nice central bank at the beginning of the country. Whoops, I'm going to go back on that. That Mr. Hamilton put in 1791. It did a great job, but it was politically unpopular. It's a good institution economically, politically unpopular. It loses its charter in 1811 when the Senate ties and the Vice President of the United States breaks the tie against the bank, so it goes out of existence. The U.S. is then embarrassed financially in the War of 1812, so the first thing they do after the War of 1812 is create a second Bank of the United States. James Madison and others did that, Henry Clay, and it gets a 20-year charter, but then Andrew Jackson vetoes its charter in 1832. You know, people didn't like this big financial institution. So we ended up with a fragmented banking system, Glass-Steagall type legislation, break up commercial and investment banks. The backlash today, there's a lot of second guessing of what maybe Tom and I are doing it here today, second guessing what the Fed did. Bernanke's reappointment was close. Congress's reform bills are calling for Fed audits and more control. I think central bank independence, and Tom mentioned this, is under threat. Of course, who's going to gain from all this? By studying 200 years of U.S. history, I can tell you that there were a lot of people who gained financially when they got rid of the first and second banks of the United States. So who's going to gain if Congress gets more control of the Fed? Well, this is from Barron's. There's a couple congressmen coming down the steps of the Capitol saying, I never ever dreamed I'd be able to spend money ad infinitum. See, what we learned in this crisis is that the Fed, no longer hampered by gold, can create any amount of money, and Congress, which likes to spend money, is taking a look at that, and I suspect that there are some people in Congress who are saying, gee, if they can create that money, imagine if we had more control of it, then we could spend more money. And, they don't say that. They say they're worried about the Fed getting into things it wasn't going to do, but there could be some hidden motives there behind Congress's attempts to get greater control of the Fed. Well, we're in this brave new world now of no gold standard. The balance sheet could double in the 1930s, but that was only because a lot of gold flowed in. World War II, the Treasury could order the Fed to double its balance sheet. But, I read a piece in the Federal Reserve Bulletin, 1945, when a person in the Division of Research and Statistics named Roland I. Robinson said the Fed was bumping up against its gold reserves, having created all that credit in World War II, and something would have to be done to allow the Fed to expand the money supply, but they were actually worried about its reserves. Well, we ended the link to gold in the 1970s, so we're in this brave new world where the Fed can easily double its balance sheet in a matter of months. And I raise at the end the question, is this some sort of Pandora's box, where if we open it, have we opened a box and it's unleashed a lot of things that we're going to regret later on? That's what Tom said he worries about. What are some of those things? Will Fed independence go away? Congress get control of the bank? Will we have a lot of inflation? Those are the issues we really have to worry about now. Thank you very much for your kind attention.
Okay, thanks very much, Dick. So the plan now is to take about 22 minutes for questions and answers for our two NYU speakers. Then we'll have a bit of a break, and we'll come back, reconvene, and have a panel of people who are at least broadly associated with Washington University to comment on these things, and then with more discussion later on. So we have plenty of time for some give and take here. So I'm here to moderate, sir.
I'd be curious, historically, who's provided housing finance, but more importantly, who's going to do it in the future, and it would add an observation that there's a major trend right now in public and private pension funds to invest in longer dated securities, which precludes them investing in mortgage backs unless they do a lot of derivative stuff. And I just wonder who's going to finance housing was the main cause of our crash going forward? The Fed?
Well, you know, that's a part of the regulatory puzzle that no one has come to grips with yet. So when we shut down or put into receivership Fannie and Freddie, several things happened. One is that there had been a long history of people believing but being a little unsure about whether the debt of Fannie and Freddie was secured, was guaranteed by the government. That uncertainty was taken away, but there was no comparable institutional innovation put in place. And so in the interim, in the interests of keeping the mortgage markets functioning and making sure that housing isn't subject to further declines, the Fed has stepped in and become the funder of the mortgage. That's not.
I agree that the Fed did what it did. Tom adverted to this, that there was a crisis, you know, they had a real problem. They wanted to keep us from going down the tubes. I think many of us feel that they were successful, that what we were going through a year or so ago could have had the effect that was, you know, characteristic of the 1930s. Things could have been a lot worse. You know, they're not great now. We're still worried. Unemployment is too high, but we didn't get deflation. The economy seems to be back growing again. We're not slipping down to, you know, 4 years of price collapse and unemployment getting to 25%. So I think the Fed stuff did work, and they did it in the short run. But what Tom and I both said is that what the Fed, you know, what they do for technical reasons to try to prevent a financial crisis from making things worse, you know, it has a lot of political implications. You're rescuing firms, you're allocating capital to one sector of the economy and not another one, and you know, the political system is going to take a look at that and say, are they really supposed to be making those decisions? You know, maybe we better rein them in. And other people are saying, well, maybe if we rein them in or Congress gets more control of it, you know, they'll be able to make those decisions. I mean, I don't think Ben Bernanke thought he was getting into a lot of political stuff, but I think now he's realizing that everything he did can be, you know, given a political spin, and somebody, the main thing is, I would say, from 200 years of American history, that there's going to be a lot of people saying, you know, this is really very powerful. For them to create more than $1 trillion of new balance sheet out of thin air in a couple of months in the fall, you know, that's a lot of power. Should they have that power? And you know, I think we have to ask ourselves that too.
I think that I mean, there's a long history around this issue. In the 1940s, there was something called the Fed Treasury Accord, in which basically the Fed and the Treasury agreed that the Federal Reserve would act as an instrument of the Treasury in helping to finance the needs of the war, and that persisted on into the 1950s, I guess, and then
actually
51. But then after that, there was a long history of struggle between presidents and heads of the Fed, and it was a guy named William McChesney Martin who finally kind of solidified the independence of the Fed. And it's been challenged many times. I mean, Richard Nixon and Arthur Burns had a notoriously stressful relationship, I think, over issues of monetary policy. So it's a little hard to see how this is going to play out. I think one thing that is going to happen, and it may be, it's probably a very good thing, is that there will be more transparency on the part of the Fed. But there will be, if this populist movement is as strong as I think it is, there will be a lot of wanting to get into the underlying balance sheet of the Fed and the decisions that they make and everything else. So,
Norman.
Reference the change in the asset quality that we have now as a major factor. I totally agree with that. But somebody's been left out of the discussion that's been light on for weeks, months. You know, 6-8 months ago, we used to talk about toxic assets. You don't hear that mentioned anymore. And it appeared to me the reason we don't is they may get a Federal Reserve balance sheet. But I'm asking this as a question. How much of that mortgage-backed securities is really, as I would call, good security? And how much of that, all the toxic assets that have available from us?
Right. Yeah, no, actually, most of that is agency.
They want to be Steve, that'll be your job.
Okay. So what about toxic assets?
Yeah.
How much of mortgage-backed security in the Federal Reserve balance sheet today that we see do you suspect are toxic?
Okay, thank you. How much of the mortgage-backed securities of the Fed's balance sheet are toxic?
The part that I showed, the tremendous growth, almost none of it. That stuff is all, those are all conforming loans issued by Fannie and Freddie. So they have to be very high quality. That's not toxic. There may be some toxic stuff in the Maiden Lanes and other places. Most of the toxic stuff, if we don't call it toxic anymore, what do we call it? Legacy assets. That's what they're called. Right. That's still on the balance sheet of the banks. So the PPIP program, which was designed to get them off the balance sheet of the banks, is just a major failure. Basically nothing happened.
Yeah, that's a problem we have to clean up.
Norman, let's let Dick respond. Let's let Dick respond, please.
Well, I was going to say that I think the toxic assets are still out there on the balance sheets of the banks. And there's a little bit of denial going. It's like in Japan in the 1990s. You know, they had a lot of toxic assets on their balance sheet, but they and the government pretended they weren't so bad. We're in a state of where we're pretending that our banks are sort of okay now, and Congress actually helped the banks a little bit by saying you don't have to count these on your balance sheets at what you could actually sell them for today. You can make some more generous accounting valuation of them. But we have to clean this up. I mean, this is something we're sort of postponing. I think maybe we want to get out of the crisis a little more, but we got to get those toxic assets out of these balance sheets.
I'm wondering if we are going to have in the future a continuation of what is it now, legacy assets, unless government policies change, that a large portion of the problems created by the government trying to saddle the financial institutions with social programs of making loans to obviously unqualified lenders. So the lenders who look at their loans as a source of cash flow, knowing these were poor loans, naturally wanted to get them out the door, allow for the funding of the loans and so on. And is there any indication that the government's going to back out of this, trying to make a social program out of a financial?
Well, the government is still trying to prop up the housing market in other ways. There's been a tax break for first-time home buyers, which has helped to prop up the market. Certainly the fact that the Federal Reserve is such a huge buyer of mortgage-backed securities helped to prop up that market. But there's very little subprime or Alt-A lending taking place now. I think what happens, what's more of a problem is that what do we do in the future to prevent those kinds of abuses? Because, subprime lending is not a bad thing as long as you price the risk correctly. If we lend to, poor women in India, we call it microfinance. If we lend them money to buy a cow, those are definitely subprime borrowers, but we charge 23% interest rate that reflects the risk of those kinds of loans. So I think we need to find financial regulatory solutions that don't deter innovation. Innovation in financial markets it's not all good, but it's not something to be stifled. So the problem is, I think, that getting the incentives aligned correctly. And the problem is that people could do these things, make these loans, without having any skin in the game. They make them, so it's originate to distribute model, and that model's got to go. You originate the loans, you distribute it, you collected your commission, and so that model was too prevalent in the financial system, and that's what we have to, I think, address.
Sure. Thanks a lot.
Yeah, I think just a suggestion. We talk a lot about the moral hazard problem, and I'm not sure. Just to push back a little bit, I'm not sure how big it is. In the sense that the CEOs of these companies that failed, they lost a tremendous amount of equity wealth. They were fired, and if you look at the losses racked up by these companies, in some sense, though we don't know how things will be settled, they're dwarfed by the losses racked up by Fannie and Freddie. And if we look at the turnover in government compared to the turnover of the CEOs, I think we find there's a lot less turnover in government.
So the question is,
there might be a moral hazard problem.
how big was the moral hazard problem? We talk a lot about it. How big was it?
I would say that right now it's not something I lose any sleep over. People are shocked, as you say. Some of these leaders lost a lot of money, their own holdings. Anybody who's head of one of these firms now is trying in a rescue mode. But the problem is that when we come out of this and life gets back to normal, and one nice thing about knowing all those financial crises that I had on my list on an early slide is that the world does come back to normal. So let's say 2-3 years from now, where people are feeling pretty good again, maybe they'll still be cautious for a little while. But 5 or 10 years from now, somebody will come into those banks and they'll say, "Hey, we can make a lot more money if we don't change something. If we get our leverage ratio up and we keep our reserves down, we can make a hell of a lot of money." And there'll be great temptations to do that if we don't change the way we regulate these institutions. So it's not something that's a problem right now, but it's a long-term problem. And they're going to say, if heads we win, tails the taxpayer picks up the bill.
Willful underestimation of risk, and risk is just perceived, and it's not clear that the regulator has a better idea of what the risk is than the CEO of the bank.
Well,
Yeah, but I'm gonna disagree with you and with my distinguished colleagues. I think it's a big problem, even right now. So, what happened? Why did the banks come roaring back last year? They came roaring back because they had been rescued. They had very low cost of capital and no constraints on the business they do. So they have been making continued big bets with money that is so cheap. Because why? Because the taxpayer guarantees the losses. So I think that they have had an incredibly low cost of capital, which has enabled them to earn enormous profits in the past year, and that's why they've come back so strongly.
Dean Greenbaum.
Proposing that we go to narrow banking design.
I don't have that.
Also for the Federal Reserve, we should have narrow central banking as well as commercial banking.
Yeah, I'm not narrow banking is, there's something to be said for it. It's an old idea. There's a book coming out by Larry Kotlikoff called which is a very interesting book. Mutual fund banking. It's called Jimmy Stewart is Dead. That's the title of his book, and
but we all knew that.
So.
Been left in place, and we haven't allowed the banks to increase their leverage into 30 or 40 times. We have had this crisis, and should we put Glass-Steagall right back in place and go back to where it should have been?
Glass-Steagall is narrow banking. It's former narrow banking.
I'll tell you why that's a difficult question to answer, but because by the time Graham-Leach-Bliley, which is the law that formally ended Glass-Steagall, was passed, it was already irrelevant. The banks had gotten their tents under the nose. The investment banks had gotten their nose under the tent of the commercial banks, and vice versa. And what did in Glass-Steagall and its effectiveness was the high inflations that we had in the 1970s, that the restrictions that we placed on banking were no longer viable. So they started introducing now accounts. We started introducing more sophisticated money management accounts that broke down the distinctions between various kinds of banks. Now, should we go back to something like Glass-Steagall? So Paul Volcker thinks that we should limit the risk-taking activities of deposit-taking banks, basically get rid of proprietary trading. I have some sympathy for that. I don't think that's such a bad idea. I think it at least would address the problem that I alluded to about banks playing with the house's money, essentially guaranteed by the taxpayer. I don't think that's the only. I don't think that's all that's needed to address the issues of systemic risk that are out there in the system. I think we need that might be helpful, but it won't eliminate systemic risk. I think what we need to do is treat systemic risk like pollution. You tax it at its source and try to thereby discourage its creation. And there are proposals out there. There are some elements of that in the House bill. So I think that we might get back to something like a Glass-Steagall world in which some activities are ring-fenced, and I don't think that's necessarily a bad thing. I think, you can't, my view, with apologies to the bankers in the room, not the central bankers, but the others, you can't listen to the complaints of the bankers about how their activities would be constrained by a return to Glass-Steagall. We put in place Glass-Steagall in the 1930s, and it was followed by it worked incredibly well for 40 years. The modern model of investment banking grew up in the United States. It evolved in the U.S. Other countries adopted it. They didn't all have the kind of restricted banking system we had. A lot of them had universal banking, but we did just fine. What did it in was inflation. That's what undermined Glass-Steagall.
I'm wondering if the historian wants to comment on Glass-Steagall.
Well, I would just say, and you talked about getting rid of Glass-Steagall in 1999, and you adverted to the SEC decision in 2004 that allowed the investment banks to increase their leverage a lot. There was a clear case where several investment bankers from leading firms in New York, including Henry Paulson, the head of Goldman Sachs in 2004, went to Washington and said, there's no reason why you tell us we can only lever up to 20 times our capital. The world is safe. There's a great moderation. We're perfectly safe going to 30 or 35, something like that. And the SEC knuckled under. What we came through was a period of 30 years where, almost every old regulation that restrained bankers was challenged by bankers, and the people in charge of regulation, maybe people in the White House, sort of bought the argument that, yes, maybe we were too restrictive, let's relax it. So there were a whole series of relaxations, and they probably spoke to these problems that arose in the inflation of the 70s. But we just relaxed the regulations, and finally, the banks levered up, and they did a lot of proprietary trading, and and then house prices didn't keep going up, and we got into this mess.
Let's take one more question here.
You both stress the importance of the independence of the Fed and the ability to act in a tough manner, independent of political like border politics in general. But I mean, to me, it almost seems like the last two crises were almost directly caused by the Fed not being able to compete and allowing asset prices to really get a little out of hand. I mean, there's plenty of evidence about individual Federal Reserves allowing lending practices to go on long after warnings were kind of brought out to them. And so I'd love to hear one rebuttal of how independent the Fed really is. And I guess two, there's been a lot of talk about regulating asset prices in the future. If you have any color as to what shape or form that might take, that'd be great.
So the question is, if I remember everything, something about should the Fed regulate asset prices, and more broadly, how independent is the Fed really of the banking system more broadly?
Well, I would say that one of the big changes going forward will be, that they will pay much more attention to asset prices. That's a lesson. The Fed's position just a few years ago, Greenspan, even Bernanke reflected it, was that we don't know whether there's you never know that there's a bubble until it bursts, and so we can't know. They're not so smart that they can recognize a bubble, but so their policy was then say if a bubble in fact occurred and burst, then the Fed will spring into action and do something about it. People like Henry Kaufman, I'm the Henry Kaufman professor, so I know Henry pretty well. He said in the late 1990s that the Fed should not allow the dot-com bubble to go so far, and Greenspan said, well, we can't do anything about it. Henry suggested they raise margin requirements, and Greenspan said, oh, they're so sophisticated now they'll just make end runs around it. But the Fed, I think the Fed made a mistake there, that they, the tragedy of it is there was a man named Edward Gramlich who was in the Fed, and he came to Alan Greenspan and said, there's some, there's irregularities in subprime lending, and the mortgage market seems to be becoming overheated. And Greenspan, his attitude was, the markets get things right. We can't know, was sort of saying, we're not smart enough to know, and the markets are good. And so, so I think the Fed should be independent, but that, the history of central banking is they're better when they're independent than when they're under the thumbs of the politicians. But they're human, we're all human, they can make mistakes. So we ought to think more about the kind of people we put in charge of our independent central banks.
Okay, well, we're at the end of our first session. I think there's some refreshments outside. We'll reconvene in about 15 minutes for the panel discussion. And let's thank our New York University twins once again.